Welcome to our latest video, where we reveal the most effective price action trading approach you'll ever need. This approach is really simple to follow and has been created to effortlessly improve your trading skills. Prepare to transform your trading strategy with this simple trick. Here are the steps. Step 1. Location. Step 2. Pattern. Step 3. Entry. These are the essential elements for making profitable deals. In this video, we will break down each stage with detailed explanations and real-world examples to help you discover the finest trade setups. This approach is intended to identify explosive moves in any market, making it appropriate for both new and experienced traders. In addition, we will go over advanced risk management ideas to assist you reduce risk and maximize revenues. Time frame. We have widely used this approach for Forex trading during a 4-hour time frame. While the technique is based on price action concepts that apply across all time frames, it may be modified to any time frame. However, be warned that the strategy's win rate and profitability may fall when you shift to shorter time periods due to greater market volatility. As a result, prior to trading with real money, the method must be carefully back-tested. Now, let's break out the strategy. Step 1. Location. In the first phase, we determine when and where we will look for potential deals. This is a trend-following method, which means we want to identify different market trends. In an uptrend, we hunt for buying opportunities, whereas in a downtrend, we seek selling opportunities. We shall not trade while the market is range-bound. To determine the trend, we employ two exponential moving averages. Although simple price action can be used, beginners may find moving averages more useful. The chart shows two exponential moving averages. The orange line represents a 100-period EMA, and the blue line indicates a 200-period EMA. These moving averages assist us in determining the current trend. In an uptrend, the 100 EMA remains higher than the 200 EMA, and both moving averages are curved upwards. In contrast, during a downtrend, the 100 EMA is lower than the 200 EMA, and both moving averages are slanted downward. After we've identified the trend, we should attentively evaluate the price activity. In a trending market, price action follows a zigzag pattern. This means that in an uptrend, we see large impulsive surges upwards and tiny pullbacks downward. Similarly, in a downtrend, we witness significant impulsive downward swings and tiny pullbacks higher. Our objective is to enter at the conclusion of a retreat in order to capture the next impulsive move. However, we cannot trade every pullback randomly. We need to wait for a specific pattern to emerge during the pullback. If you found value in this video so far, please like it and subscribe to our channel Trader Yoda to ensure you don't miss any future videos. Step 2. Pattern. Pullbacks are divided into two types: strong pullbacks and weak pullbacks. Strong pullbacks are prevalent in the markets, and they can be distinguished by firm momentum and large candles. These pullbacks stop abruptly, making them difficult to trade. On the other hand, weak pullbacks are distinguished by a slightly sloped consolidation pattern. They're more common and less pointy, making them easier to identify and trade. These are sometimes known as flag patterns or wedge patterns. We focus our bets on these weak pullbacks, expecting the price to consolidate during the downtrend. This shows that the tendency is still strong and the opposing force is minimal. We want the price to pull down to the 100 EMA, resulting in this consolidation pattern. In rare circumstances, the price may form this pattern but not approach the 100 EMA. We will not trade such patterns. We need the price to get very near to the 100 EMA, resulting in an obvious consolidation pattern. Once we've identified a pattern, we'll draw a line linking the highs to form the upper boundary. Similarly, we draw another line linking the lows to define the bottom boundary. With both boundaries established, we await our entry trigger to proceed with the trade. Step 3. Entry. Our entry for this approach occurs when the price breaks out of the pattern with a strong closing candle. For example, in an uptrend, we search for a bullish green candle that rises over the pattern's upper boundary. This candle's closure should be near its highest point. We will buy when such a candle closes. In contrast, during a downtrend, We seek for a bearish red candle that breaks below the pattern's lower boundary. This candle should come to a close near its lowest point. When the candle closes, we will enter a sell position. Trade management, or risk management is an essential component of any trading strategy. A good risk management plan can turn a lost approach into a highly successful one. Here's a basic way to manage this technique. For a buy trade, set your stop loss slightly below the pattern's upper boundary. Set your targets based on a risk-reward ratio of 2:1. Similarly, in a downtrend, set your stop loss exactly above the pattern's lower limit and your goals at a risk-reward ratio of 2:1. Advanced trade management. Once you've gained trust in the tactic, you can go on to more advanced trade management techniques. For this, we use the 20 EMA to track our earnings. For a buy trade, set your stop loss below the pattern's upper boundary and aim for a risk-reward ratio of 2:1. Once the price advances in your favor and reaches the target, exit half of your position and adjust your stop loss to break even. This way, you've secured half of your transaction's earnings while keeping the remaining deal risk-free. You can stay in the trade as long as the price is above the 20 EMA. Exit when a candle closes below the 20 EMA. Use the same procedure for a sell trade. Initially, set your stop loss over the bottom boundary and aim for a 2:1 risk-reward ratio. After you've met your goal, exit half of your position and change your stop loss to break even. Continue to trade as long as the price remains below the 20 EMA. Exit the remaining trade when the price closes above the 20-day average. To review with trading examples, the chart shows two moving averages. The orange line indicates 100 EMA, while the blue line represents 200 EMA. First, note that the price is regularly trading above the EMAs, with the 100 EMA above the 200 EMA and both moving averages sloping upward. This suggests a robust uptrend. In such an uptrend, seek for buying opportunities during pullbacks. When you spot the pullback to the 100 EMA, you've completed the first stage. At this stage, look for a consolidation pattern to validate the trend strength. We draw the upper boundary by linking the highs of the consolidation pattern and the lower limit by connecting the lows. Our second phase is accomplished now that we have discovered the pattern during the pullback. We are now waiting for the price to break above the upper boundary before we enter. On this candle, the price breaks above the upper boundary, resulting in a solid green candle that closes near the high. We enter a buy trade at the conclusion of this candle with a stop loss below the upper boundary and an initial aim of 2:1 risk-reward ratio. When the price reaches our target, we close half of our positions and put the 20 EMA on the chart. We leave the remaining half when the price closes below the 20-day exponential moving average. In this case, trailing the stop loss did not provide any further benefits because the exits were essentially equal. Trailing pauses, on the other hand, can be useful for capturing greater moves. Here's another example. The 100 EMA was higher than the 200 EMA, indicating a strong advance. The price broke above the EMAs, resulting in an impulsive up move before pulling back to the 100 EMA, establishing a consolidation pattern. We draw the upper boundary by linking the highs and the lower boundary by connecting the lows of this pattern. We then wait for the price to rise above the upper boundary. On this candle, the price breaks above the upper boundary with a solid green candle, indicating a buy trade. We position our stop loss below the upper boundary and aim for a 2:1 risk-reward ratio. The price meets our aim on this candle. At this time, we close half of our positions and adjust our stop loss to break even. We then put the 20 EMA on the chart to track our profits. We will exit the remaining trade once the price falls below the 20 EMA. As shown, trailing our gains enabled us to capture the whole move in this trade, demonstrating the value of trailing stops. Now let's look at a sell trade. On this chart, the price was trading below the moving averages with the 100 EMA lower than the 200 EMA and both EMAs sloping downward. This verifies the price's downtrend. In a downtrend, we only focus on sell trades. We're waiting for the price to draw back and form a consolidation pattern. Here, the price pulls back, forming a consolidation pattern. We create the lower border by linking the lows and the upper boundary by connecting the highs of this pattern. We then wait for the price to drop below the lower barrier before entering. In this scenario, a massive red candle with a strong closure breaks the lower boundary, triggering a sell trade at the candle's close. We position our stop loss over the upper boundary and aim for a 2:1 risk-reward ratio. When the price reaches our objective, we exit half of our position and adjust the stop loss to break even, making the trade risk-free. We then use the 20 EMA to track our profits. When the price breaks above the 20-day moving average, we exit the remaining position. In this case, we capitalized on a large price movement and earned outstanding gains. Here's another example. We see that the 100 EMA is below the 200 EMA, and both EMAs are trending downward, indicating a significant downtrend. The price makes a significant down movement before pulling back. During the retreat, we see a consolidation pattern. We connect the pattern's lows to form the lower boundary and the highs to form the upper boundary. We then wait for the price to fall below the lower barrier before initiating a sell trade. On this candle, the price breaks below the lower limit, with a huge red candle that closes solidly near the lows. We enter a sell trade at the candle's close, with our stop loss above the lower border and a risk-reward ratio of 2:1. Once the price reaches our target, we will close half of our position. We then use the 20 EMA to track our profits. We will exit the remaining trade whenever the price closes above the 20 EMA. However, not every deal will be that uncomplicated. Here is an example of a chart where you should not trade. On this chart, the 100 EMA is below the 200 EMA, and both EMAs are sloping downward. The price was trading below the EMAs, indicating a downtrend based on the EMAs. However, observing the price action reveals that the price was moving within a range. We must observe impulsive advances and pullbacks to identify a valid trend. If the price is moving sideways, even if the EMAs indicate a trend, we should avoid trading. Here's a great arrangement with only one little drawback. On this chart, the 100 EMA has crossed over the 200 EMA. Since then, the price has remained above the EMAs, with both EMAs sloping upward. More importantly, we see a powerful impulsive move with a weak pullback, which reinforces our uptrend bias. We see a pattern in this consolidation. We define the upper border by linking the highs. A massive green candle with a powerful closing pushes the price above this threshold. However, this candle is too big to properly trade. If we enter a buy trade at the closing of this candle, we will need to establish a huge stop loss and much higher goals. Our goal with this strategy is to capture the next impulsive move, and we prefer to enter at the very beginning of the move. Given the scale of this candle, it suggests that we are already halfway through the next impulsive movement. Therefore, it is recommended to avoid trading in this circumstance. This strategy is based on probabilities, and such trades are considered low probability. As a trader, you must master two important skills. First, how to trade high probability trades, and second, how to avoid low probability trades. Mastering these two factors will help you become a successful trader. That concludes this video. We've presented a 3-step price action approach to assist you capitalize on trending moves. As always, we recommend backtesting this approach on your choice instrument before investing real money in it. If you want to discover more trade strategies, subscribe to our channel and hit the bell icon. See you soon.